You remember how in 2007, again, 8, 9, housing crisis, all these companies went under, financial institutions went down, Bear Stearns, all that stuff, Lehman Brothers, and then they're scooped up, pennies on the dollar by J.P. Morgan and whatnot, and big shark eats little fish, and an interesting thing has happened and happened then, but this happened in 2008, or 7. So it's funny, 2007, and we're in 2017, both with sevens on the end. Interesting, not that that matters. But there's an interesting thing that was happening in 2007 that has been happening in 2006 and even now 2017. And this could be the end of the show for this, and that is mergers and acquisitions at obscene levels for prices, paying more than what anyone should ever pay. This is an article from Wolf Richter. Why does the pre-collapse year 2007 keep popping up in mergers and acquisitions? Stock market exuberance drives merger valuations to record high. Deal logic. Announced, keep that word in mind, he says, announced, quotes, announced global volume of mergers and acquisitions, announced in quotes for a reason, more on that in a moment, has breached the $700 billion year to date for the first time since the crazy pre-collapse year 2007. Is this not amazing? This includes 125 deals of over $1 billion, totaling $455 billion. 3 industries are at it with the most vigor: oil and gas, healthcare, and technology. This surge in mergers and acquisitions has been driven by cross-border acquisitions, which have doubled in the last 5 years to $288 billion in 2017 year to date, according to Dealogic. They're now also at the highest levels since 2007. U.S.-based companies are on top of the heap of cross-border deals with $95.8 billion in announced acquisitions so far, the highest year-to-date level on record. What caused the surge in mergers and acquisitions? According to Dealogic, strong equity markets and valuations, stock market, which have soared to the highest level on record. These valuations are measured in what we're going to call EBITDA, which is earnings before interest, tax, depreciation, and amortization, EBITDA, a metric that reflects the target company's operating performance by removing non-operating expenses. For the first quarter, 14 times EBITDA is what the Dealogic figures show as the median EBITDA multiple, explains Dealogic's head of M&A research, or mergers and acquisitions research, Chungshek Chen. That's something we really haven't seen over the course of the data that we have. Historically, we've been bouncing between 10 and 12 times, sometimes even 13 times. So 14 times EBITDA is certainly a premium to pay for acquisitions. Major stock indices are hovering near all-time highs, he said, hence the high volume and all-time record premium. This is really a translation of the exuberance in the equities market, he said. This merger boom is really driven by valuation. In other words, higher stock prices beget even higher premiums that acquirers are eager to pay. Over the long run, mergers and acquisitions rarely produces positive results, except for the stockholders of the acquired companies, executive bonuses, and Wall Street investment banks that happen to manage these deals and extract their fees. Many mergers turn into abysmal operational failures, followed by layoffs, and often enough, ironically, spin-offs. And once again, even with the spin-offs, Wall Street wins again. Companies are struggling with the tough environment beyond cheap credit and sky-high stock prices. They've been stuck in an earnings quagmire for years. Combined earnings of the S&P 500 companies in quarter 4 2016 were back to where they'd been 5 years earlier in 2011 quarter 4. So why would anybody all of a sudden value these companies like that, some that maybe in the S&P 14 times that number? Where does that come from? Well, powerful stock market. Can you start to see how when the Federal Reserve gets involved and doesn't let a free market actually be free, and if a bank needs to fail, let it fail, and if an investment house needs to fail, let it fail too, and not only that, don't give trillions of dollars away to offshore banks and other countries, foreign banks, and don't print massive amounts of money, quantitative easing, and don't all of a sudden become the number one buyer of our own treasury debt to pretend like other countries are buying it when really it's us. Can you see how the Federal Reserve can screw with everything? And it's going to try to keep, like remember when Ben Bernanke said, we got a few more tools in our toolbox. This isn't all. QE said we got more tools in the toolbox. That was his famous phrase. We got more tools in the toolbox. I don't know what tools you guys have been using in that toolbox, but I think they're made in China and they're destroyed as soon as you use them. They're junk. And housing prices astronomically high, way higher than they should be. Interest rates held down near zero for way too long. Now they're starting to creep up, and they're starting to creep up because the Federal Reserve is doing it too. And it's having a negative impact as well because mortgages are going to have to come down, or the price of houses are going to have to come down because the interest rates are going to go up. You can only afford so much per month to pay. Therefore, high interest rates means low house price because that's all I can afford at that interest rate. We have these absurd rents. Again, tons of mergers and acquisitions, all-time high now, prior to 2007. Rinse and repeat. You got people in the flipping house businesses again, the commercial industry, they're out there flipping them, but we're doing 30%, now they're down to 20%, not to worry. The small guy, that's you and me, we've seen what they're doing, we want to get in on that action. We're going to flip. We're going to get in there and flip some houses. When are we deciding to do this? With both hands? Storming to the front? I want in on that action. When are we doing this? At the worst possible time in history. This is a repeat of 2006, 7, and then 8, boom, it hits. 2009, oh my gosh, this is horrible. 2010, this is even worse. And then right around between 2010, 2011 or so, there were some really, really, really good deals on homes. Again, I'll tell you again, I live in approximately a 3,000 square foot house. We rent. It's the biggest house I've ever lived in. It's a nice house. It's 2 stories. Not too much of a 2-story fan, if I don't mind being honest with you. And I don't. Up, forgot something in my room. Go up the stairs, turn, go up the stairs again, go in my room, get what I forgot, come back down the stair. That's not fun, especially when you got a foot that's been screwing with you for a long time like mine. So I said this before, but again, I always get new subscribers every day, and I feel like I'm leaving them out if I don't repeat some of this stuff. So bear with me, some of you guys. This house was sold, because I looked it up, Zillow tells me, 2012, sold for $125K. Built in 2005. You're telling me, and this is Florida, I live in Florida, near Tampa area, technically speaking, Tampa, Brandon area. This is not California. This is not New York. We're not talking $600,000 house for you sitting inside of a bucket, calling that home for $700 a month. No, there's reality here. Average house, $200K, that kind of stuff. And when the getting was good, these houses in here were selling for over 300 plus and higher. 380, I think, was one of the ones right down the street that's a little bit bigger than this house. And this house sold for $125. So that's why I'm telling you, I'm renting. I will continue to rent. And when the freaking floor falls out of the real estate market, I'm hoping, fingers crossed, I'll be able to buy a house cash money. I don't know that I'll be able to accumulate that kind of cash in that amount of time. And when I say that, that also includes me selling my silver stack if I need to get that house paid off in full. Because once you get a house and it's paid off, things can get pretty rough out there economically, and you could go work for horrible pay. Like that would psychologically scar you, where you used to be paid and now I'm working at this, like I don't even feel human anymore, like it's so low. You wouldn't feel that because, oh, my house is paid off. I just have the basic bills, electric. Of course, you still want mortgage insurance, in case your house freaking burns down or something. But you get the point. So if this is to follow like last time, and let's say this is 2007, that means 2018. It might even be here this year, to be honest with you. 2017 could actually be like 2008. In September, it happened. In 2009, oh my gosh, which would mean 2018 would be, oh my gosh. Add 2 years to that if we repeat 2008 with the mortgages and the houses coming down, whatever. That could put us out 2 years, 2000, call it 2018, 19, 20. By 2020, maybe 2021, you could have fire sales of homes. I do think it's not going to take that long this time around because everything's bigger and worse. I think the implosion is going to happen faster, sooner than we're expecting, and more devastating, which means the fire sales you might actually get, if this house were to do that again, 50K, 75K, I don't know. But I think we're going to see some of that because everything, now that the Federal Reserve has meddled in everything, has to all be dealt with. And the only way to deal with it, bubble upon bubble upon bubble upon bubble upon bubble, that's inside a giant bubble created by the Fed, let it go, baby. Let them go. Boom, 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 boom. See where they all drop, start over. It's the only thing that can keep the insanity from going on longer. Insanity being the extreme house prices, extreme rental prices, this nonsense merger and acquisitions paying way more than they ever should, flipping condos and flipping houses. If you're not aware of any of this and you just happen to join my channel recently, you may want to stick around because I'm going to enlighten you on a lot of crap that you're probably not hearing on the news or on the TV. So, it says, but there's an additional, well, first of all, it says, in this environment, corporate America cannot come up with the earnings growth despite or because of the huge wave of mergers and acquisitions. So what's the solution? More mergers and acquisitions at record prices and record multiples. But there's an additional kink in the equation. The collapse of announced, remember that keyword he said earlier? Announced merger deals. These mergers were announced with great fanfare. Their huge premiums were hyped with glowing words. They fired up the entire sector and even stock markets for a few days, as analysts were pronouncing the next potential targets, whose shares then jumped. But then the proposed mergers run afoul of regulators who are worried belatedly about monopolies or oligopolies, or the proposed mergers run into the buzzsaw of other issues, and suddenly the merger collapses and is withdrawn. Just on Wednesday, the $14 billion merger between two stock exchanges, the London Stock Exchange and the Deutsche Börse, was withdrawn after regulators had a hissy fit. This brought the total of withdrawn mergers in quarter one to $271 billion, according to Dealogic, the second largest amount of withdrawn mergers ever in a first quarter, only behind quarter one 2007. You starting to see the picture here, how this is going to end? Rinse and repeat, cycle, rinse and repeat, cycle, rinse and repeat. And every time that cycle in between that middle, there's new sheep. There's new blood. And they never freaking learn. If pre-collapse year 2007 keeps popping up, it may be for a reason. This quarter included the second largest withdrawn merger ever. It was proposed, shrugged off, and revoked within a couple of days in February. Kraft Heinz Co's $155 billion bid for London-listed Unilever. It's behind only Pfizer's $160 billion effort to acquire Ireland-based Allergen, which collapsed in April 2016 after the U.S. government started targeting inversion deals that were primarily engineered to dodge U.S. income taxes. Last year had already seen the highest withdrawn deal volume since 2008. In total, 769 deals for $842 billion, partly reflecting heightened regulatory pressure, as J.P. Morgan put it. And J.P. Morgan had an additional explanation for the merger boom, beyond the crazy stock market valuations. Buyers capitalize on low cost of funding. Oh, you mean like near 0% interest rates with the Fed handing out money to all these corporations, these financial institutions? The big corpo, right? Yeah. They've been able to borrow at near zero. which also helps them fund their stock buybacks, which also pushes their stocks higher. Because as people want to sell off, they just buy them up, buy them up, buy them up, buy them up. So they use borrowed money to do that. And they're using borrowed money for this, and interest rates are starting to rise. The gravy train's going to be ending soon. Cash deals funded by borrowing money rather than issuing shares accounted for 62% of the deals in 2016, up from 54% in 2015. In this year, despite rising rates, the cost of capital is unlikely to be substantially impacted, emphasis added, and we do not think any increases will impede merger and acquisition activity. So, he says, full steam ahead. Overpaying is a virtue. Bogged down earnings, no problem. Record debt levels and leverage are signs of corporate health and confidence, not the other way around. As Wall Street likes to say, exuberance reigns, eerie sounds of 2007. Last time automakers tried this was in 2009. He says, Reed Auto Industry resorts to biggest incentives ever just to slow down the decline in sales, which I talked about the other day. Same guy, Wolf Richter. So where does this leave us? Leaves us in the same place it left us last year and the year before and the year before and the year before that. It's a cycle. People think a few years go by and everything's fine, and we get back into our old habits. But how much debt was out there in 2007 and 8, and how much debt is out there 2017, 2016, and soon to be 2018 when we start to roll into the bigger problems, I believe? Answer, way, way, way more. If you just look at just one single country, the United States, 10 trillion turned to 20 trillion. 8 years. 2008, basically, to 2000, we'll call it 18. Again, it's right around the corner. 10 years total. I said 8 years, whatever. I say 8 years because it's Obama's 2 terms, and it's technically right there at pushing 20. Now it's over 20. Anyways, I'm rounding off. That's just the U.S. We doubled our national debt. Other countries added tons of their debt. You think our numbers are bad here with the consumers spending, like it's a chart I showed you in my last video? Debt, credit, people in debt, credit, boom, and retail sales declining, and they've already crossed. In 2013, they crossed, so people are now more in debt, and retail sales are still declining. Not looking good. And guess what? It's not an American-only thing. It's not an American-only thing. It's a whole world thing. Debt, 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 debt everywhere. So whatever we experienced in 08 and 09, and I know a lot of people lost their jobs, their pensions got destroyed then, their 401ks got destroyed then. People lost businesses they had. Again, going by the data, the math, in theory, whatever's coming and how soon it's here, it's going to be a hell of a lot worse. And if the club, the ones who tells our government what to do, decides these bubbles have been inflated enough, we're not going to do this again for another 8 years, it's time to clean house, let's stop this, reset everything, pull everything back down, then it's going to be even worse than that. Because they're not going to try to prop things up and try to do this to fix it. They're going to say, let's let this thing go down and let's start, as they always say, ordo, whatever the hell that Latin thing is on the back of the dollar, order out of chaos or whatever the hell it is. Well, the dollar one's, I think, New World Order, but the other one is order out of chaos. But the question is, we now have Trump in here. Trump's not supposed to be in here. He's not supposed to be the president, but he is. So whatever plans the club had, are they still on like Donkey Kong? Or is he going to have a nice little market rally and everything I'm talking about now is not going to matter? We're going to print $2 trillion more dollars, add to the debt ceiling. We're going to make it $3-4 trillion in no time. Give us one last shot in the arm of drugs, so to speak, and then, who knows? We'll see where it goes. But this is hard data. This is stuff that will fundamentally change things. Not the hopium you hear on TV, the hopium smokers telling you, consumer confidence is up. The Dow Jones ended the day is 65 points higher. This is utter nonsense. The same thing was said right before 1929. Weeks, days before 1929. Markets are rallying. There's no end in sight. All-time highs. The markets are... And then the floor got pulled out. Like a thief in the night, right? Anyways, take care.